There's so much talk today about the bank of mum and dad and how a kid's going to get into the market and the wealth transfer across generations and all that kind of stuff. Mm-hmm. I know if you talked about this bank of mum and dad stuff to my parents, they'd be like, we worked really hard to save our deposit. Yep. I know we worked really hard to save our deposit. You know, the kids are just on the silver spoon. They're on the take, you know. Why can't they save their own deposit? What do you think, Cam?
It's a good one because I've had this silver spoon thrown at me a few times, and I grew up in the country and did it poor and left home, as you know, at 16 and saved for a deposit and worked multiple jobs and didn't go to a cafe till I was 25 and did the hard yards. But I only ever saved for that one deposit. Then the future growth of each property is paid for the next and the next. But let's look at the real numbers because I've helped my kids out to get into the property market. So Felicity and I have just purchased one property. We purchased it 3-4 years ago now. And it's gone up about, $240,000 in that time. But we decided that it's better to put 130,000 deposit in now, and in 10 years' time, we can then sell that property, pay the tax, and split that profit between each of our 4 kids.
Yep.
As opposed to in 10 years' time, each of our kids trying to get into the property market. And I'll go through some figures so that it might dispel the silver spoon theory a little bit.
100%.
But we decided in 10 years' time, 4 kids, the deposit required to be $200,000 plus. Potentially, we'd have to fork out $800,000 in 10 years' time as opposed to one deposit now. So that was a financial decision we made. Now, let's look at the facts of things, because I know people will be thinking, back in the 1980s, I had to work and save, and I saved for a deposit. Back in the 1980s, the average property was about 3 times the average income. So the average salary back then was about $13,458. The average home value was around $50,000, depending on what city you were in, versus 2024.
Very different story, right?
Very different story. So the average salary, about $90,000, $89,000 now. The average home is just a smidge over $1 million. Mm-hmm. So the average salary versus the home value is 12 times the income. So to get a deposit together is actually 10 times harder, or takes 10 times the amount of savings to get a deposit together in 2024 than it did in 1980.
Yep.
So people can say, well, you're silver spooning. The reality is it's 10 times harder. You know, people say like, we did it so much harder in the olden days. You know, we used to bash our clothes at the river on the rocks to wash our clothes. You know, no, the reality is it's harder for kids to get a deposit. And statistically, based on that, it's 10 times harder to get a deposit together. So parents can make a choice, and I don't think that it requires a direct handout. Do you know what I mean? My kids are still saving. They've got jobs, they're saving. They're going to be required to save and show that they can budget for me to release that equity when it's time for them to get into the property market. Yeah. So they're still going to do the hard yards. I'm going to make sure they do the hard yards before they get that gift. But the reality is they're not going to get into the property market unless someone helps them out. The gap between the have-nots and the haves is getting much greater. So people out there who have got a bit of equity in their own home, have got some kids that they might want to get into the property market in the future. You know, the kids are young still. The time to do it's now, because Australian property will never be as cheap as it is now.
Yeah.
So I know you deal with a lot of clients, and we deal with hundreds of different variations of scenarios of, you know, mums and dads getting their kids into the property market. Talk us through a couple of different scenarios that you're helping clients with.
Yeah, well, you're spot on. I think to be blunt about it, you can either stick your head in the sand and not acknowledge the market dynamics today, or you can actually think creatively and say, well, if the kids are going to get the inheritance down the track, why don't we bring that forward into today to be able to get some benefit, you know, over the next 10 to 15 years, you know, until that inheritance will be due. And that's the kind of stuff that we hear from people on a daily basis. So there's absolutely been a dramatic increase in parents wanting to help their kids. In practical terms, there are a few different ways that this can happen. One is that you can go guarantor. Parents can go guarantor on a loan where the kids buy a property in their name, and the parents are basically, you know, signing responsibility to the kids to pay it. And if the kids don't, then it's on the parents to cover the loan repayments. A more elegant solution we find is what we call an equity gift. So that's kind of similar to what you talked about. Yeah. Let's say that you know, as a parent, you have $500,000 or $600,000 worth of equity in a property. You might take $150,000 or $200,000 of that equity loan, out as an equity loan, gift that equity loan across to your kids. It might be the whole deposit, it might be part of the deposit, and they've put some cash in on top, or it's very flexible how that can work. And they then borrow the rest of the value of that property in their own name. So reduces a bit of the risk on the parents, assigns a bit more of the responsibility. And you might even come up with an arrangement with your kids where the kids pay the interest on your equity loan as well, because with wage growth and incomes where they are, if the disposable income is really high, then the kids can afford that property. It's just the barrier to entry is the deposit, and being able to accumulate that. So that's where the equity gifts can work really well. Look, there are a couple of other scenarios, things like JVs with kids and whatnot. It's going to be really case by case in terms of which one works best for each client's individual circumstances, but there are a couple of the most common ones.
All right, you keen to talk to one of our clients and get them to run you through the scenario? Because I think a live example of how this really worked and the dynamic between parents and kids of getting into market. I think we've got Pascal, who's pretty keen to talk to you.
Great story.
And explain it.
Can't wait for it.
All right, nice.
So we're talking about the bank of mum and dad and how parents can help their kids get started in today's market. It's awesome to be here with OpenCorp client Paz today. Paz, you got a great story in terms of your relationship with your dad and what you enjoyed you did, and how your parents helped you guys get started on your investment property journey, and it's been super fruitful in a relatively short space of time for you guys. So. A really great insight into why it makes sense to get started as quickly as possible. Maybe could you share with people how did you get started? How did all that kind of play out?
Yeah, so Dad showed a little bit of interest in helping me get started, just because he knew being in Melbourne, the market's taking off. It'd be hard for me to just generically save and get into the market that way. So he did show a bit of interest, and I flicked him across Cam's book, My 4-Year-Old the Property Investor. And in about 2 days, he got back to me. He said, all right, let's discuss with OpenCorp and work out how we're going to do this. So, didn't expect that from him, but after reading the book, he was pretty excited to help out.
I think what's really relevant about your scenario is, having met your dad, obviously, since very much kind of the old school mindset. They had their house paid off, right, and kind of not. While they wanted to help you out, they kind of wanted to understand how the debt part happened, because they were kind of anti-debt or not super familiar with debt. So I guess talk everyone through the steps that we put in place. Like, how did it actually come to be a reality that you enjoyed to get started with your first investment property?
Yeah. So Mum and Dad did an equity release, so their home was paid off. So they didn't want to secure the home against the investment property.
Yeah.
So they did an equity release. My partner Georgia and I had some savings, not enough to get in. Mm-hmm. So they essentially gifted us that equity, and we pay that interest payment, so it doesn't affect them. So they thought that was a really streamlined and easy process that didn't affect their situation.
Yeah. So I guess you started. You and Georgia started. Before you had a family, you double income, obviously no kids at the time.
Yeah.
Covering the interest on the equity loan was easily achievable. It was just the rate that you could acquire that deposit that was the challenge. Yeah. You've since had your little girl, and I know she's the apple of your eye, mate, but you've been able to hold that investment property, getting amazing rental yield and getting significant tax benefits. So it's not impacting your lifestyle at all. And we're probably fair to say, we're actively talking about how you can use that amazing equity that you've created for the next one. So, I guess what were the key takeaways for you and your parents as we kind of went along this journey?
Key takeaways, it's just out saving the market wasn't going to happen. And also in the area that we're living in, we're in Box Hill. So the house that we wanted in the price range that we could afford at the time, we weren't able to achieve that. So investing was the way we could get our foot in the door and start to grow that equity to one day buy the dream home in 10 years or what that looks like. But it's just built from here. It's just keep building it up.
Awesome. So you talked about the dream home there, but what does the future look like for you and Georgia now you've started your investment journey, and how does it feel to be on that track in the market?
Yeah, well, we me and Georgia debrief quite a lot, and debrief with Boz as well. And after, giving Georgia some feedback, she's just like, when can we go again? When can we go again? So I think we're investing for the next 10 or so years until we're happy and we can afford the place that we want to live in.
Amazing, mate. Yeah. Well, you're going great, guns. Yeah. It's awesome to be helping with your portfolio. A really great case study of parents that are thinking the right way, recognising an opportunity, being able to gift some equity, and you've made double the amount of that equity loan in uplift in under 3 years already. So there's one for the parents out there. If you've got lazy equity that's sitting there, don't sit on it. If you want to help your kids, there are different ways to go about it. Reach out and we can give you some personal guidance based on your individual situation. But thanks, Paz, for joining us.
All right.